Okay, good morning. We are going to be talking about Chapter 12 today, which is the statement of cash flows that we've not talked about much up to this point. To start off class, we're going to talk about the exam. There is a question in Learning Catalytics that will be open for a few minutes, so get logged on to Learning Catalytics. But first I'm going to start with the exam. Exam 3 is Sunday through Tuesday of finals week. We are opening the lab. The lab, they just told me on Friday, we're opening at 8 a.m., so I'll be there at 8 a.m. You can come a little bit later. So I'll be there at 8 a.m. to open the lab on Sunday. From 8 a.m. to noon is exclusive use of the lab by my class. You don't have to come 8 a.m. to noon. You have 8 a.m. to 6 p.m. if you're taking it in the lab. But from 8 a.m. to noon, there'll be no one else there other than my students. In the past, we've had a nice steady stream of students all day long on Sunday. I'm hoping to get at least half of you in on Sunday, so that's where that bonus comes in. ProctorU, you can also take it Sunday. You have to have your exam submitted by 6 p.m. on Sunday to get the bonus. Sections 3, 7, and 8, schedule with ProctorU. If you're having any trouble scheduling at all, just pick up the phone and call ProctorU, and they can work it out with you. And again, 10-point bonus if you submit your exam by 6 p.m. Eastern on Sunday. The other thing is, I was just telling Haley yesterday, I finished the exam and the practice exam. And the practice exam is now up. I believe it became available today. Practice exam, just like the other exams, practice's exam, you can take as many times as you want. It counts as a quiz, the average of your attempts. It counts as a quiz, and it's due, in theory, before you take the exam. It doesn't cut off, though, the minute you take the exam, but it is due absolute worst case Tuesday night. So you can take it any time. It's there for you. So that is available now. There'll also be an exam info quiz the week before the exam in my accounting lab. Again, that'll be a 5-question quiz. No big deal, but that's not until next week. Okay, so there is a question on Learning Catalytics. Everyone should get this right. How do you earn the 10-point bonus on the final exam? Make your selection. I will also tell you this question's going to stay open for a minute or two. So I'm going to show the answer, but you will have a minute or two. And actually, we're going to have another question coming up fairly soon. So how do you earn the 10-point bonus on the final? And the answer is submit it before 6 p.m. on Sunday, December 7th. So you need to make sure you finish it by 6 p.m., submit it. You submitted it at 6:01, you're not going to get that bonus. Okay, so what's due this Saturday? This Saturday, all sections, Chapter 12 homework, and Section 3 also has a regular quiz. Now, the practice exam is lurking out there. It is not due this Saturday, so no worries there, but it is available if you want to start working on it. Okay, class on Wednesday. We have class on Wednesday. In the syllabus, I had put online-only class so that everyone would attend online. Since that time, Haley and I don't care if we come in or not, so just to give you options, if you prefer to come in on Wednesday, Haley and I are having class in class here, so it's online and in person. So Wednesday's just, quote-unquote, another day. So you can attend however you want, but it is a required class. We'll be finishing Chapter 12 on Wednesday. So just know that. In the syllabus it says online only, but we are going to have it in here. So you can take your pick about how you choose to attend Wednesday and every other day as well. Okay, and just a reminder, there is a question out there in Learning Catalytics. It's going to close, I guess, in the next minute or so. I'm not going to make a separate announcement that it's closing, so make sure you answer it if you have not yet. Okay, Chapter 12. Chapter 12 is a statement of cash flows, and we have not talked about the statement of cash flows much yet. And what we're going to do is we're going to talk about the intricacies of it. We're going to talk about how to prepare it. We're going to prepare some. And then Wednesday, we're going to end this chapter by looking briefly at Angie's list cash flows versus Apple's statement of cash flows. And that's kind of real interesting. We're not going to look real in depth, but you can see what you can learn about a company by looking at statement of cash flows. So that's where we're heading on Wednesday. Okay, so we're starting with the purposes of the statement of cash flows. Okay, so the statement of cash flows, we have cash receipts and cash payments. Okay, now, statement of cash flows tells where your cash is coming from, those are the cash receipts, and where your cash is going to. Okay, so how are you spending your cash? They say more small businesses fail due to lack of cash than lack of income. You need cash to be able to pay your bills, essentially. So where's it coming from and where's it going? We have lots and lots of writing today, and I would urge you, if you don't get it all written down, know that the PowerPoints are in Blackboard. Okay, the statement of cash flows will cover a span of time, either a month, a quarter, or a year. And it also includes cash equivalents, so things that are close to being cash, a savings account, a checking account, short-term treasury bonds. So it's cash and cash equivalent, everything that you have available to pay bills with, essentially. Where's all your cash? So we're looking at what we're doing with it and where we're getting it. Again, I'm going to go back on the chat window. Yeah, the only way to get that bonus is taking it on Sunday. It's open on Sunday for 10 hours, starting at 8 a.m. Sunday till 6 p.m., and that is the bonus situation. Okay, now there's 4 purposes for the statement of cash flows. I would know these purposes. This is something I would absolutely know. Statement of cash flows. We can use it to help predict future cash flows. It helps evaluate how management did at making decisions. Did management make good decisions? Did it end up with a positive cash flow? We can look at the statement of cash flows and see how well a company is going to be able to pay interest and dividends. And also, we can look at the relationship between net income and our cash flows. Those are not the same. Our net income will not be equal to our cash flow because cash flow is on a cash basis, net income is on an accrual basis. They will be different. Just as a reminder, there's 4 main financial statements. There's the income statement, the statement of stockholders' equity or statement of retained earnings, the balance sheet, and then the statement of cash flows. They're all interrelated. The statement of cash flows is for a period of time. It's not one date, but statement of cash flows says, how do you spend your cash over this period of time? Where did you get your cash over this period of time? So we have these 4 main reasons. Some analysts consider the statement of cash flows to be the most important statement. Some of them, not all of them. But if you had to pick one, some people are very much a fan of the statement of cash flows. The statement of cash flows, by the way, is a relatively new statement. It's only been in existence required for the last 25 years or so. And it's surprising now when people look at it, it wasn't always a statement and it wasn't always required. Okay, we have another Learning Catalytics question coming to you then, and then we'll start a new learning objective after this. So, statement of cash flows is designed to fulfill all the following purposes except which one? The statement of cash flows is designed to fulfill all the following purposes except to "10 seconds left on this one. The statement of cash flows is designed to fulfill all the following purposes except for" which one's not one of those purposes? And that would be assess the collectability of accounts receivable. The collectability of our accounts receivable has nothing to do with the statement of cash flows. We're not going to be able to assess anything to do with the statement, with the accounts receivable using the statement. But we are able to look at the relationship of net income to cash flows. We are able to evaluate management decisions, and we are able to predict future cash flows using that statement. Okay, so next up, the next learning objective. These first two learning objectives go really, really quick, and then we hit another one that's just going to take 2 days to cover. So this one, the statement of cash flows has three activities on it. All our cash can be grouped into three activities. You absolutely positively need to know all three cash flows, all three activities, and be able to identify cash flows as what activity they are considered. So there's three types. The first one is operating cash flows. This is our revenues, our expenses, our gains and losses, everything we have from operating our business, our reason for being. This is why we're in business, these operating cash flows. So you basically start with net income and then do a series of adjustments to it. I would start operating cash flows. Operating cash flows are the single most important cash flow to analyze. Operating cash flows represent the cash we are generating from operating our business. Operating cash flows are the single biggest indicator of what's going on with our business. So operating cash flows are the biggie. They're the important one. In most businesses, most healthy businesses, you're going to see operating cash flows be a major chunk. Okay? So operating cash flows are the most important. This is going to be net income, and it's going to be a series of adjustments to net income, which we'll talk about in a minute here. Okay, the next type of cash flow activity is the investing activities. And investing activities are cash flows related to long-term assets. Okay, so long-term assets. This is property, plant, and equipment. This is new buildings, new equipment. This is investing in the business itself. So that's what investing cash flows are. So new buildings, new equipment, but it can also be the sale of buildings, the sale of equipment. And then this final cash flow relates to long-term liabilities and owner's equity. So transactions in our stock, transactions with long-term liabilities. So when we have the statement of cash flows, we say, here's how much came from or was used by operating activities, here's how much from investing, and here's how much from financing. And then we come up with an ending cash balance. So the statement of cash flows is broken down into these three pools. It's not a bad statement at all, but what we're going to see is we're going to see a template we're going to be using, but we're not quite there yet. If you look at a balance sheet and you look at the statement of cash flows, these are generated by different parts of the balance sheet. Operating cash flows are affected by current assets, changes in current assets, and current liabilities. This is Exhibit 12-2 in your book. This is a nice, handy diagram. This can be extremely useful in certain questions you might face. So operating cash flows are related to current assets and current liabilities, changes in those. Investing cash flows are related to long-term assets on the balance sheet, and then financing cash flows are related to long-term liabilities and stockholders' equity. So the statement of cash flows is lined up very closely to the balance sheet, measuring changes in those different accounts. We're almost to the end of Learning Objective 2, by the way. So then we're going to hit Learning Objective 3 for the next 2 days. So we have a statement of cash flows, and we said all our statements of cash flows have operating cash flows, then investing, then financing, and then come up with an ending cash balance. And so that's the basic format of the statement. There are two ways to prepare the operating cash flows. One's called the indirect method, and one's called the direct method. Okay, so on this slide, what we're doing is we're comparing indirect method to direct method. You need to know which one's which, but this is important. Direct cash flow method we are not covering. So we are not doing Learning Objective 4. Learning Objective 4 is how to do the direct method. We're only doing indirect. So let me try to do, okay. So the indirect method, what we do with the indirect method is we take net income and we convert it back to a cash basis, basically, is what we're doing. We make a series of adjustments to say, here's our income on a cash basis, is what we're doing. The direct method reports all cash receipts and cash payments from operating activities. Okay, the indirect method. So first of all, let me go back a minute here. The statement of cash flows has three types of cash activities. It has operating, it has investing, and it has financing. The indirect method and direct method impact how you show operating cash flows only. So it's only operating cash flows. So when we're talking about this direct versus indirect, we are only talking about operating activities, and that's important. The rest of the statement is exactly the same regardless of which one you pick. So we have the indirect method and direct method. They both relate to how you present the operating activities. The indirect method, what you do is essentially, what you're doing with the indirect method is you're taking your net income. So you're going to your income statement, taking your net income, which is on an accrual basis, and you're taking that and you're making lots of adjustments to it to convert it to cash provided by operating activities. You're trying to convert to a cash basis income figure is what you're doing. That's the indirect method. Our information systems in the U.S. are set up to answer that question. That's how we, for decades and decades, we've developed financial accounting systems that have this information to do the indirect method. So we start with net income, and then we tell the investors, here's all the adjustments to convert it back to cash provided by operating activities. Okay? Because our net income is on an accrual basis, meaning we don't worry about when the cash comes in and cash goes out. So that's why we have to convert it to a cash basis. Indirect method is the method that we're doing in this class. Indirect method is used by the majority of the companies in the U.S. because that's how the information systems are set up. The indirect method is easier for companies to prepare because of the way everything's set up. Now, on the other hand, we have the direct method. The direct method is over on the right, and the direct method says, okay, let's not start with net income. Let's just account for all the cash we got. So we're going to list all the cash we got from customers, and then we're going to list all the payments we made to suppliers, etc., and then we're going to come up with the net difference, right? And so the direct method is easier for us to look at. We can look at that and say, that makes a lot of sense. I can understand what cash collected from customers is. I can understand what cash paid to suppliers is, and that's very intuitive. It makes a lot of sense. The big problem with the direct method is information systems are not set up to capture that information. okay, at least in the U.S. That's a huge, huge cost for us to convert everything over to that. So at this point, most companies use the indirect method. Now, international financial reporting standards, there is no such thing as the indirect method. So if a company is going to use international financial reporting standards, it has to use the direct method. So it's just very costly to prepare the direct method. Direct method is easier to understand. The indirect method is easier to prepare. So up to this point, most U.S. companies are doing the indirect method. So again, in this chapter, what you see on this slide represents what you need to know about the direct method. Okay, so this is it. We're not doing Learning Objective 4, but the only difference between the direct method and the indirect method is on how the operating cash flows are presented. The operating cash flows will be, the total of them will be the same under both methods. It's just how do you present it, what information do you supply. The direct method, basically you're saying, here's all my payments, here's all my receipts, and here's my net difference. The indirect method starts with net income on an accrual basis and then makes a bunch of adjustments to it to convert it to a cash basis net income, basically is what we're doing. Okay, so again, you do not need to know how to do the direct method. What you need to know about the direct method, we've just said on the slide and know the information on here. And then everything we do from this point forward, we're going to assume we're using the indirect method. We don't need to be told we're using the indirect method if we're looking at investing activities or financing activities. It's only operating, and I'm telling you now, we're doing all indirect method. So rather than do both, we're just going to do indirect. We're going to do the one that most companies in the U.S. use. Okay, so that said, we have a question coming up here. True, false? Of the 3 types of business activities reported on a statement of cash flows, investing activities are the most important when we're evaluating a business. True or false? Of the 3 types of business activities reported on a statement of cash flows, investing activities are the most important when evaluating a business. Ten more seconds. That is false. The reason it's false is it's not investing activities, it's operating cash flows. We're looking at how the company is generating its cash from its operating activities. When you're in business, you're looking at why am I in business? What are my operating cash flows? That's what we're most interested in. Investing activities are assets, long-term assets, like buying buildings, buying equipment, or selling buildings, selling equipment. That's not why we're in business. And financing is the long-term debt and stock that we're issuing. And again, that's not why we're in business. We're in business to sell our products or our services, so operating cash flows evaluate that our result of our operations. Okay, so now to Learning Objective 3. Learning Objective 3 is the big one. This is where we're going to spend the rest of our time today and Wednesday. We are not doing Learning Objective 4. Learning Objective 4 is the same thing, only direct method. So we're just going to do Learning Objective 3. We're doing only indirect method. Okay, it's going to be a ton of writing. You're not going to be able to write all this in class. I'm going to point out some pages in your textbook, or maybe something to come back to grab a screenshot later. Page 670 in your textbook. This is a template for how to do a statement of cash flows. Absolutely, positively, on my reference sheet for the exam, I would have this. You can write it fairly small, and you could fit it in a corner, and it's going to give you so much information. And this is what we're going to be talking about for the most part for the rest of the time. And I'm going to blow some parts up now. So when we talk about the statement of cash flows, this is a statement just like any other statement we have. I'm not going to blow up the top of it, but it starts with the name of the company, then the name of the statement, and then the period ending. A statement of cash flows is for a period of time. The only statement that is as of one point in time is a balance sheet, where we're looking at account balances on a particular day. All the other statements are looking at activity over a period of time. Okay, so first we're going to start with the cash flows from operating activities. So this is the biggie, and this is also the most confusing section. This is because it's what we're doing conceptually with this section is we're starting with net income, which is on accrual basis, which means we're recognizing income that we maybe haven't gotten the cash for. We're recognizing expenses that we haven't paid for yet. So we're starting with net income, and we're converting it to a cash basis, just like if we were using cash basis accounting, which we're not allowed to. Then we have investing activities, and then we have financing activities. So statement of cash flows is going to say, here's our operating cash flows, here's our investing cash flows, and here's our financing cash flows. So we're going to have those three sections, and then down at the bottom, we're going to come up with our ending cash. Okay, so we've got this statement, so it's fascinating, and on Wednesday, we're going to look at Angie's list statement of cash flows, and then we're going to look at Apple's statement of cash flows. And those are very interesting to look at in real life. In real life, you can tell a lot about a company from its statement of cash flows. So we have these three sections: operating, investing, and financing. So looking at operating, I'm going to blow that up. So I'm taking my operating cash flows and I'm going to make it bigger. So we have like a template. And again, we're going to see this again. Let me look here. Yeah, we're going to see this a couple times. So what we have with the operating cash activities, so cash from operating activities, I've blown it up, that section up. The first thing in the cash from operating activities is always going to be net income. That starts it. What we're doing is we're taking net income, which is an accrual basis number, and converting it to cash. So, and again, you may not get to write all of this down, and I would urge you to go back and either look at page 670 in your book. This is a screenshot from your book. Or come back to the recording and grab a screenshot of it. Okay, so the first thing we're going to do is we are going to start with net income. Okay, so that is the first thing. That is always going to be the case. Okay, so we're going to start with net income. That's going to be first. Now, after we have net income, we're going to add and subtract a series of adjustments. Now, these adjustments are this big line that follows that. These adjustments that are going to come are taking that net income to convert it to net cash. So what we're doing, what you're seeing next, are a list of items to adjust that. So we start with net income. You should know this first thing is always going to be net income. So we have to do our statement of cash flow, or we have to do our income statement before we can do the statement of cash flows. So we're saying, here's the list of adjustments I'm going to make. And now is where we get into things that really feel weird, okay? So the first thing we do is we add back depreciation, depletion, and amortization expense. Why are we adding expense to net income? The reason we are is we think about depreciation expense, what it is. Depreciation expense is a non-cash item. So we have to add it back to net income to get, which remember, our end goal is to convert our net income to a cash figure. And if we've deducted depreciation or depletion or amortization, we need to add it back. It was a non-cash item. The next item down, we're adding back loss on sale of long-term assets. And again, a loss is a non-cash item, not the sale itself, but the loss is based on a bookkeeping entry, so it's a non-cash item. So we're adding back that loss because it would have been deducted. We're going to subtract the gain, and same deal. So when we buy and sell a long-term asset, it might have a gain or loss. That's a non-cash item. The actual purchase price or sale price shows up on the statement somewhere, but the gain or loss is non-cash. Then the biggies here, and these are the hardest ones to understand. Right here, we subtract increases in current assets other than cash, because any increase in a current asset other than cash is going to require a use of our cash, kind of. Decreases in current assets other than cash. So that feels backwards. We're going to subtract an increase in current assets, add a decrease in current assets, add increases in current liabilities, and subtract decrease in current liabilities. This is one of those things that I struggled with probably a few years after learning this, and I always had to refer to it written down, absolutely positively. So this statement, and again, if you don't get it all written down, we're coming back to it. You'll see it again and again. But this whole thing right here, you're going to have to know. Write it on your sheet. This is one of those things. Do not waste brain power trying to memorize all this. It will fall into place later. But we want to at least be able to use a statement of cash flows and not be saying, why do we subtract that or add that? What we're trying to do is we're trying to convert things that have been accrued or deferred into cash, and we have to make all these adjustments. So our statement of cash flows has operating activities, it has investing activities, and it has financing activities. We know that operating activities are the most important cash flow to evaluate because that's why we're in business. We want to see. So this is the basic format. So when we do statements of cash flows in here, if we're doing the operating activity section, we're just going to use this template. So even though it's confusing and it's hard to memorize, you don't have to memorize it. You put this whole template for this statement on your sheet and you will be good to go. And I'm going to show you some questions coming up. We're going to do some questions where we use this. So we're going to be using it today. We're going to be using it on Wednesday, and you'll see. You just use it. It makes it very simple, but you have to rely on this because you don't get tripped up with thinking. You say, oh, I have an increase in a current asset, let me add it. You have to subtract it, but then current liabilities are different. So this is just use the sheet, and eventually the pieces do fall into place. Okay? And again, we will see this template again coming up in a couple slides. Okay, so the first step always, okay, so these are things you should note based on what you have written down. The first step is always start with net income. So if you see net income, that's going to be the very first line in that operating cash flow section. And then you have a series of adjustments, okay? So you have the net income, then add or subtract a bunch of adjustments, and then you're going to have the total provided or used by operating activities. Now, provided by means the number's a positive number. If we have a negative number here, it means operations took more of our cash than they used. So that's why you have used by. That's why you have used by in parentheses. Used by will be a negative number, meaning that operations consumed more cash than it provided, which usually is not a good thing. Okay, so next up, the template for investing. And this one's smaller. There's a lot less activity with investing. Remember, investing activities deal with long-term assets. Okay, so what's in long-term assets? So investing activities. Sales of long-term assets, including investments, land, building, equipment. So any of those long-term assets are going to show up in the investing activity. Purchases of any of those things. So if we sell something, it's generating cash. If we buy something, it's going to be shown as a negative because we're using cash to buy it. We'll have collections of notes receivable, long-term notes receivable, and long-term notes to others. I just want to point out that that's assuming that these are long-term. If we have a short-term notes receivable, it'll be up in the current asset section. So investing activities, not bad. Investing activities, we're going to have sales of long-term assets, purchases of long-term assets, use it, collections of long-term notes receivable, and subtract loans we've made, long-term loans we've made to others. So we end up with net cash provided by or used by investing activities. So investing activities, we've got long-term assets. We're focused on what's going on with long-term assets. If we sell something, it brings cash in. If we purchase something, it's cash going out, used by. And then our last section on the statement of cash flows is financing activities. And financing activities deal with long-term liabilities and stockholders' equity. So what we're going to see in that bottom section is we have cash generated by issuing stock. We have cash generated by selling treasury stock. Remember, treasury stock is our own stock that we purchase back. Well, if we sell that, that generates cash. If we purchase treasury stock, it reduces cash. We have to use cash to buy it. If we borrow using a long-term note or a long-term note bond payable, that's a source of financing cash flows. And then payment of a long-term note or long-term bond payable is going to be a use, as are payments of dividends. So financing activities, we're going to get cash by issuing stock, by selling treasury stock. We're going to use cash by buying treasury stock. And so those are our financing cash flows. So this statement, if you have this template, you should be well equipped to deal with just about anything when we're dealing with this statement. But again, write it down, have it in the corner of your sheet. It'll be quite useful to you for answering questions. Okay, this template was on page 670 of your textbook again. And now I want to go back and look at the whole statement again and just point to sections. So we've gone through 3 sections so far. So down at the bottom, we have at the bottom of the statement, it gives us our last year beginning balance of cash, plus the activity this time gives us our ending cash. So how we get that bottom amount is we take the cash provided by operations plus the cash provided by financing or investing plus the cash provided by financing. We add or subtract those as need be, and those all get added to the beginning cash to come up with ending cash. So that's our statement, are these 3 cash flows. We're going to do a statement coming up here after we do a few questions. We're going to do a statement of cash flows, the operating cash flow section first. but that's what we're doing when we do the statement. We have the three operating cash flows. We take the net difference, add it or subtract it to the beginning cash, and end up with the ending cash. Don't write these down. These are exactly what you just did, but if you'd like a little more detail or in bigger print, or you don't have the textbook to look at page 670, you can download the slides, and I have that same, it's printed out in bigger letters, so it's easier to read. Also, operating activity on those slides, they're spelled out. So if you don't want them in a list format, if you'd rather have on the one side positive items and negative items, meaning positive items increase cash, negative items decrease cash. This is operating activities. The next one will be investing activities. So again, these are exactly what we just did, just a little more detail in case that makes more sense to you. So I would urge you to download the PowerPoint slides if you want that kind of detail, but it is exactly duplicating what we just did, so I'm not going to go through them here. But in case that makes more sense to you or you're struggling with it, there's a different way to look at it, and those are on Blackboard under PowerPoint. Okay, so now we're going to do a few questions, maybe several questions. Probably going to do several questions here. So we're going to use that idea, the template that we just went through. We're going to look at different items and see what kind of cash flow that would be. Because that's going to be a bunch of the questions you get in this chapter. How do you classify this? So the first one is issuance of stock. So we have a company issuing stock. Where is that going to be reported on the statement of cash flows? Operating, investing, or financing? So make your selection. And we're going to go through these pretty fast because there's going to be a whole bunch of these saying how do you classify this one, this one, this one. So looking back at the template, how do we classify issuing stock? When we issue stock, which operating activity, investing activity, or financing activity is that? Another 10 seconds on this one. Like I said, we're going to do several of these right in a row. So issuance of stock, 10 seconds left. When I'm looking at this one, issuance of stock. Issuance of stock, if I think about where that goes on the balance sheet, stock is stockholders' equity. So anything in stockholders' equity or long-term liabilities belongs in financing. Okay? So issuing a stock is a financing activity. Next one up. Long-term borrowing. So this is our long-term bond payable or long-term note payable. Where is it reported? What type of activity is it reported as? Operating, investing, or financing? We're going to do these pretty quickly, so we're going to take about 10 seconds on this, 10 more seconds, and then we'll go on to the next one. Long-term borrowing, that's a long-term liability. It's financing section. Okay, next one up. If we pay dividends, so payment of dividends, we're paying dividends to our shareholder, what type of activity is that? How is it reported on the statement of cash flows? Another 10 seconds on this one. Think about what section of the balance sheet dividends relate to. It's going to be financing because dividends have to do with stockholders' equity. So paying dividends is also financing. Next one. Purchase of land with cash. So we go out and buy land. Maybe we're going to put a building there. What type of cash flow? Where is that reported? Okay, 10 seconds left on this one. We buy land. Think about where land is classified on the balance sheet. That's an investing activity. Land is a long-term asset, and that's long-term assets are reported in the investing activities. No, sale of building, it doesn't matter when we're going to sell it. If it's building, it is going to be investing. Unless, of course, our business is buying and selling buildings, in which case that would be inventory, that would be operating, but that's way beyond, that's a very, very specific thing, and we are not assuming that we're in the business of buying and selling, keeping buildings as inventory. So, okay. Purchase of treasury stock. So think about what treasury stock is and where this would go. 10 seconds left on this one. Purchase of treasury stock is financing activity. Treasury stock is in stockholders' equity. Just about two more of these, and next one, paying bonds payable. So we're making payments on our bonds payable or paying them off. What section of the statement of cash flows does that show up on? Ten seconds. And that's financing. It's a long-term liability, and they belong in financing activities. You can finance your business through long-term liabilities or equity. It's basically what we're looking at there. Just wanted to emphasize again that page 668, we saw it earlier, when we're looking at a balance sheet, current assets and current liabilities both are operating cash flows. Long-term assets are investing cash flows, and then long-term liabilities and stockholders' equity are financing cash flows. So again, page 668 has that nice little diagram there. Then I have got lots of questions today. So here's another one that's a little bit different. We haven't talked about this before. Okay, a gain on the sale of equipment is subtracted from net income when determining cash provided by operations under the indirect method. True or false? And this is one absolutely I would expect you to look at that template. Look at the operating cash flows, see what you do to gain. And we'll take 10 seconds or so on this one. Okay, a gain on sale of equipment, that is absolutely true. Because a gain on sale of equipment, the gain itself is a non-cash item. And it's an adjustment. It would have been included in income. So now we subtract it out. We're trying to adjust income back to a cash basis. The actual sale of the equipment itself, the sale price we get is in the investing section. This is the adjustment for the gain, which relates to the book value. It's tied up with depreciation and all that kind of stuff. So it's a non-cash item. So we're backing the gain out. We're subtracting the gain because we would have, the gain would have increased income. We're converting back to cash, so we have to pull it out of there. Okay, now Exhibit 1210. This one's just like the exception slide. Now we talk about we buy a building with cash. We buy equipment with cash. We sell something for cash. Those are all on the statement of cash flows. But if we go out and purchase a building by issuing common stock, which happens, cash was not impacted. We don't want companies to avoid reporting these things by simply using non-cash. So on the bottom of the statement, there'll be a list of transactions, non-cash transactions. So having to do with investing and financing. So this is investors can see Boy, in this case, acquisition of a building by issuing common stock. So no cash was involved there, but that's information an investor would want to know. Did we get a building? That's a big thing. Acquisition of land by issuing a note payable. So we can't avoid reporting investing and financing activities by using non-cash. It's simply a non-cash investing and financing section of the statement. So be aware that non-cash items show up at the very bottom. So they're not part of the statement, but they're at the bottom. So they're not included in the totals, but it's there because our investors need to know this as well. Okay, I have one more question and then we're going to do a homework problem. Okay, the best gauge of a company's ability to produce ample cash to continue as a going concern is net cash provided by what type of activity? The best gauge of a company's ability to produce ample cash to continue as a going concern is net cash provided by what type of activity? About 10 seconds left. Okay, it'll be operating. Operating is the big one. Operating is the one that's going to give us information about the company's operations, why they're in business, and looking at whether that company is a going concern, meaning going concern means it's going to continue into the indefinite future. We would be looking at operating cash flows. We want the business to be generating enough cash to support itself. Okay, now we're going to do short exercise 12.5. Short exercise 12.5 gives us a series of data, and then it asks how we should report cash flows from operating activities using the indirect method. So you know how our statement has operating activities, investing activities, financing activities, and then the cash at the bottom? In this exercise, we're doing only the operating activities. Okay, so we're just doing one part of the statement. So we're going to do the operating activities. So operating activities, we would look at our template. We would look at that template we had, and the very first item on the template is always going to be net income. So net income is given to us. So we're constructing the statement. So it says net income for the year was $76,000. So we'll see net income is our first item. So we're doing just the operating activities section. Now, we start with net income. Net income is a cruel figure, meaning we have all kinds of items that didn't carry cash with them in there. So now we want to take that net income and we want to do a series of adjustments to adjust it back to a cash basis. So we're going to have that big long title. I just call it Adjustments to Reconcile, but the official title is Adjustments to Reconcile Net Income to Net Cash Provided by Operating Activities. So we're having net income and then a whole slew of adjustments, and this is coming off that template. So the next thing is depreciation expense. In the template that I gave you, gives you the typical order. So you would have net income. First adjustment you're going to have is depreciation, depletion, or amortization expense. So we're given depreciation expense. We add it back. That's because depreciation expense is a non-cash item that would have been deducted from income to get our net income. So now we're adding it back. It's not cash, so we want to add that back in there. Okay, so depreciation expense. The other, in that same sentence, it tells us included in net income was a $3,100 loss on the sale of land. Well, looking at our template, loss on sales is next. So we're going to add that loss back too. I know I'm adding it back because it's on my template. That loss would have been deducted to get at net income. Now we want to add it back. When we're dealing with gains and losses, they were based on original book values, so a gain or loss is a non-cash item. The entire sale price shows up in the investing section, but the gain or loss needs to be, net income needs to be adjusted by that. Okay, so we have net income, series of adjustments. So we have depreciation we're adding back, loss on sale of equipment, And then we have to add back or subtract changes in current assets and current liabilities. So our next one is, it began in the sentence, we have to do a little math for this one. It began the year totaling $56,000. It ended the year with $59,000. So we had an increase in current assets of $3,000. Increases in current assets, according to our template, are subtracted. So we're going to see this $3,000 subtracted there. So we have to look at the beginning of the year balance, the end of the year balance. The difference is $3,000, and we subtract it because it increased. Again, looking at that template, that's where you can answer all these questions and prepare this by going back to those items. And then the very next sentence, it tells us what current liabilities they had at the beginning of the year and the end of the year. Current liabilities were $41,000, end of year was $45,000. So we had an increase in current liabilities. And looking back at our template, we're going to add back increases in current liabilities. If we're going to subtract anything, we put brackets around it. And again, we're going based on the template. What we do we add or subtract it? And then our final step here is we're going to take the $76,000 income, we're going to add the depreciation expense back, add the loss back, we're going to subtract the increase in current assets and add the increase in current liabilities, and we come up with net cash provided by operating activities of $92,100. This $92,100, if we were in a cash basis accounting, so if we were just recording when cash came in and cash went out, our net income would be $92,100. So when you look at this, our cash net income is $92,100. Our accrual-based net income is $76,000. So the two are quite different. But we have to start with our net income and then add or subtract the adjustments to get back to this net cash provided by operating activities. Now, just a comment about this, net cash provided by operating activities here is $92,100. It's positive. That means this company is generating cash by its operations to help support itself. Now, we'd have to look at investing and financing to get more of a picture, but at least this says to us that this company is generating cash from its operations. So you would say on this that the company, it does have positive cash flow from its operations. Okay. Next up, we have another question here. So let's do another question. Okay. Depreciation expense is reported on the statements of cash flows as operating, investing, or financing. Another 10 seconds on this one. Okay, depreciation is an operating activity. And the reason we know that is we look at our template. Depreciation expense is the #1 adjustment to net income, to convert net income to a cash figure. Okay, we do not have enough time to do the next homework problem because the next two are connected. So I'd like to end here today, and then we're going to pick up on Wednesday with a few questions and then go into the remaining homework problems, and then we're going to look at Angie's list and Apple's statement of cash flows. So that'll be it for today, and I'll see you on Wednesday.